Hello everyone. Today we have a topic for the lesson that many traders are afraid to talk about. It's risk management. Quite often, many avoid this topic because they lack knowledge or work with a misunderstanding of risk management. Today, I will tell and show you everything. Let's go. Risk management. What is risk management? It is the management and control of potential financial risks with the aim of potential profit and to minimize potential losses. One of the most important topics in trading is risk management. Even if you perfectly see the market and trade well in backtesting, in real trading, without knowledge of risk management, you can only expect to lose your deposit. Let's get to practice. How to calculate risk per trade. To build effective risk management, you need to understand a few points personally. The first point. If you are trading, for example, with $1,000 and you get stopped out, what risk in dollars from your deposit would not harm you mentally? $1, $10, $15, it doesn't matter. The essence of this question is for you to understand for yourself how much you are willing to lose. This is done so that you do not worry and do not get nervous about the loss. You must minimize your risks not only to preserve your deposit but also to maintain your sanity. If you do not think correctly and do not adhere to risks, your trading will turn into an ordinary casino. The second point, each person has their own number that they set for the stop loss, and each person has their own understanding of how much they are willing to lose in a particular trade. But we will take the most optimal risk as 1% of the deposit. In our case, 1% of $1,000 is $10. That is, if the price goes against us and we get stopped out, we will lose only $10, which is 1% of the deposit. How to calculate the risk for the day? We have already dealt with the risk per trade. The daily risk is individual for each person. Suppose we calculated our risk management in such a way that we are comfortable trading 5% of the deposit. This is the daily risk. The number of trades we make during the day is adjusted to our daily limit. That is, for each trade, we allocate 1%. That is, suppose we have 1, 2, 3, 4, 5 trades. Accordingly, we allocate 1% risk per trade. Thus, if we made 5 trades and got stopped out 5 times, we reached our daily risk. And everything is fine. That is, we calculated risk management in such a way that we are comfortable in case of loss. Here, someone, for example, wants to enter a trade with the least risk, but at the same time with a larger number of trades. For example, a person calculated their risk management in such a way that they are comfortable trading with a 3% risk per day. And let's say, make 6 trades, 1, 2, 3, 4, 5, 6. That is, the trader makes 6 trades, but their daily risk is less than 3%. Accordingly, the risk per trade is also less. That is, we divide 3% by our number of trades and get 0.5 each per trade. Thus, if we hit the stop loss 6 times, we will still stay within our daily limit. And everything in risk management will be clear and straightforward. In fact, the topic of risk management is quite individual. Each psychotype has its own risk management approach. For example, 1% per trade and 2% risk per day works for me. I feel comfortable this way. If I hit 2 stop losses, then I generally do not enter the market that day, because I have a psychotype that can easily inflate risks. Therefore, I feel comfortable trading with normal risk. The most optimal, for me, that is again 1% risk per trade and 2% risk per day. So I make a total of 2 trades per day. If not, I leave the market, and that's it, I feel comfortable. Something like that. Now let's talk about the rules of proper risk management. The first rule is to always Use a stop loss. If you do not use a stop loss, your trading and your deposit are already doomed. Therefore, control your risk and do not give in to emotions. The second rule: limit the size of potential losses to an insignificant amount for the deposit. For a proper structure of risk management, you need stability. Accordingly, your trading strategy should have clear boundaries outlined. For me, for example, it's 1% risk per trade and 2% risk per day. With such risk management, I feel comfortable trading, and I do not in any way overestimate my risk. The third rule: apply the same risk to all positions. It doesn't matter what has happened in your life, in the market, at work, and so on. Do not give in to emotions. Stick to a clear plan. If you cannot control your emotions on a given day, it is better not to trade at all. Next, the fourth rule: making the right decision to open a position. Stick to your trading strategy. Unjustified risks should not be present in your trading and your life. Next, the fifth rule: two identical positions mean double risk. Even if you found a good trading situation and decided to enter it twice, remember that this is double risk, which can lead to losses. Therefore, if you want to open multiple trades, it is better to open them with a smaller volume while still entering the daily risk. So, that's about it. Basically, in this lesson, I wrote and talked only about a small part of risk management, but this is the main part. In the next videos, I will talk about some more interesting points in risk management. So that's all for now.